Give us a scoop here, Abhishek, as to what's happening.
Hi, Rishad. So the main reason why Morgan Stanley is reiterating what everyone else has been saying over the last few weeks, the money is moving out of the US and is chasing EM, is largely macro. I mean, a weakening dollar, a peak in the dollar has been accompanied with China's reopening. We all know China came late to the reopening party. It's the latest to join. So these two tailwinds are making emerging markets and in general non-US assets a lot more attractive for investors. Now, this is the macro reason. The technical side, if you look at the positioning, the currencies, and even the valuations, like you were just discussing, is really cheap. So, there is merit in diversifying away from the US, which is actually looking at a recession, to a region where none of the countries are looking at a recession. Even in terms of bottom-up attributes, if you look at the earnings for Asia, EMs in general, they've started to outperform globally. This feature was missing from China's from the global scene since before October. So as China reopening came in, this tailwind started improving outlook for a variety of assets linked to China, and China being the anchor for Asia is leading the earnings estimates and valuation as well. So US is not offering any of these attributes right now and is looking at a recession to a soft landing kind of scenario. But Asia, EMs in general are offering a lot of this.
But Asia in particular, and how much has the mood music from China and how that has changed contributed to this decision and others to start favouring the emerging market space?
I mean, China's reopening has contributed immensely. It began with the, dollar's peak in September, October sometime. I think the Bloomberg dollar index is down about 7-8%. But China reopening, has the power to decouple the dependency Asia, EMs, and rest of the world has on US for growth. So even if global growth sees a sort of a soft landing or a recession kind of scenario, this time around, because China is joining the reopening party, a bit late than others, it provides that strength to Asian and EM economies in general to weather any sort of downturn in, US markets. So China contributed immensely. I mean, if you look at Morgan Stanley's call as well, I mean, they are talking about being market weight on China, which is about 30% on the MSCI EM index, and they're also overweight on India. I mean, India
was last year's kind of darling, and it did very well. It was one of the few places where the major benchmarks actually saw a gain. But that, again, is not being seen quite the same as, China, because a lot of the money which would have gone into China went into India. But is that money being now reallocated towards China now as opposed to where it was before?
So in terms of global allocation, yes, the money is going towards China. If you look at the Bank of America survey, if you look at what Goldman has said, if you look at EPFR data. But in terms of Asia allocation, India still commands a bit of respect, because if you look at the bottom-up estimates, India gives you the best earnings growth this year and probably the year after. So in that context, if you plot the valuation relative to earnings growth chart, India won't look expensive because the earnings growth are just is the best in the region.
Multiples are more. It's an expensive market. It is traditionally an expensive market if you look at it. Yeah.
Exactly. It is expensive. It remains expensive for a reason, because it offers better ROEs, better earnings growth, and that story is, somewhat expected to continue. So, China would rise. It's a tactical bet, but India is a structural opportunity to a lot of asset managers.